All right, so I just got off the horn with a nice guy. He was wondering what the heck is going on with the intelligent portfolios over at Schwab. And this is a good guy, man. I like this guy a lot. He says they got a lot of, he's got thousands of holdings. He's got lots of, Russian oil stocks or something. I can't remember exactly what he said, but I think he said Russian oil stocks. And he said, what is going on? And he's not mad or griping, he's just wondering what's happening. So let me explain to you how these intelligent portfolios, the Vanguard personal advisory services and whatnot. Vanguard stuff's actually quite simple because they just basically have four holdings: the total stock index, total bond index, international stock index, and international bond index. But what happens with these portfolios? They really want to follow something called modern portfolio theory. Now, I've always found the modern portfolio theory thing to be such an overplayed thing. This is the only investment you can have a free lunch. The only way you can have a free lunch is what these investment guys say. Because when one thing is going up, one thing's going down, something else is going up. And as we're going through right now, it's just not the case, my friends. Everything is going down. I can't say, I don't know what gold's doing, so maybe gold's going up. I don't know. Commodities are probably going up. I think energy stocks are going up. But anyway, the point about modern portfolio theory is if A is going down, B is probably going up, thus you get a free lunch. I've always found that to be a silly way to look at it. Anyway, essentially the SEC, the Securities Exchange Commission, basically says modern portfolio theory is the way to go in terms of protecting yourself, I guess. I hate to say from lawsuits and stuff, but kind of from lawsuits, from being judged that you misallocated someone's assets. And so modern portfolio means you can't just have large cap stocks, domestic. You have to have bonds. If you're somewhat, of a conservative nature or a moderate investor, you have to have international, you have to have emerging markets, you have to have across the threshold of the investment world. Now, the problem with that, of course, is that no one cares when the markets are going down or going up. When the markets go down, people start saying, hey, I want to look at my portfolio and see what's going on. And then they're going to see that, wait, why do they got this fund or that fund? Why do they sell out of this fund over that fund, which is what my man just said. And that's absolutely acceptable question to ask. So what happens when I was at USAA, and this was when I was at Schwab and Vanguard's before we even had these kind of things. So USAA, we had them, what the hell are they called? Some kind of accounts. Separately managed, no, they're not SMAs. I forgot. Anyway, diversified portfolio, I don't know what they are. But what happens is they have analysts who say, hey, we found out that this guy who runs this emerging markets fund is smoking crack. So we're going to sell him and we're going to buy this guy over here who's as pure as a wind-driven snow. Or part two is we had a target price on ExxonMobil at 80 on the high end and a sell price at ExxonMobil at 50. So once it hits those numbers, we're going to sell it on either side, if that makes sense. So this is what happens with these things. So like my man was saying, hey, why do they sell this or do that? I said, because they had, I can't speak on behalf of intelligent portfolios, but I know they have target prices on when to get out, to get into a position. They look at the portfolio managers. They say, this guy sucks. He's smoking crack. Well, this guy's great. A lot of that stuff is, you would think they would do on the front end, and they do. I mean, they do that on the front end before they invest money in various managers. But you're always wondering, well, how come you didn't know this guy was smoking crack when you researched him? Maybe he just, I don't know, maybe his wife left him and now he's, about to jump off a bridge. I don't know, and I'm being obviously silly saying this. But anyway, the point being is, my man's like, dude, should I get out of it? I said, look, you got to do what you got to do, but there's no reprieve. Everything, I told him, my Wellington, we're down about almost 20% in Wellington. There's no escaping this. Everything is down except for energy stocks. And there might be one other thing that's up, but if everyone had, excuse me, if you had all your portfolio in energy stocks, you literally made no money over the last 10 years. And so I asked my guy, and kind of being a tough love, I said, so he's down about, he's down to probably 5% or something like that. Yeah, something like that. I said, so he basically has lost everything he made over the last year. All right, so from when he started with Intelligent Portfolio, he was at 500. Now he's at 500. So he's even Steven. I said, okay, so what did you start with a couple years ago? More than 500 or less than 500? Of course, the answer is he started with well below 500. I said, okay. What did you start with 10 years ago? above 500 or less than 500? Of course, the answer is he started with well below 500. Again, you see what I'm saying? So don't, and this guy's good. I'm not bashing this guy. I'm just saying, don't be, I'm down 5 to 10%. Why don't you guys just stay out here with me? Don't be saying I'm down 5 to 10%. That's frustrating. And this guy wasn't like that. When you're up 300 or 400% over the last 10 years, don't be that guy, because that's not reasonable. That's not reasonable. He just wanted to make sure I was still keen on the intelligent portfolios. I said, yeah, absolutely, man. It's diversified. You got professional money managers looking over it. It doesn't charge you that much. It's 100%. Does that mean it'll be the best thing? I don't know, but it works for me. I don't own it. I own Wellington and VTI with a couple of stocks. And I sold ExxonMobil. It went up another 50% after I sold it. 50% after I sold it. I bought UGI, and it went down 50% after I bought it. So there you go. There's old buddy Josh right there, kicking butts and taking names. The Wellington's down 20%. It's just the nature. There's no place to go. So my man was like, well, I'm looking at the S&P, and S&P has smoked everything else, and so it's like nothing beats it. And so that's not true. He goes, yeah, look, I've looked at it. I said, what's your time frame? He said, 2 years. I said, that's the problem. If you looked at the odds, everything beat the S&P 500 in the odds. If you look over the last 10 years, not that much is beating it, but does that mean the S&P 500 is going to beat everything? I don't know. I mean, I like the S&P 500 index, but I see what Schwab is doing, going back to modern portfolio theory, is they're trying to have a diversified asset allocation. And they're not going to change, because that is what the rules of the roads are now when it comes to this kind of not separately managed accounts. Wrap accounts, that's what it's called, wrap accounts. You basically are having a bunch of different mutual funds and ETFs wrapped into one account. That's what they call them. And that's just the way it's going to be, man, is that they're going to wrap it, and they're going to have a bunch of different holdings out there to make sure they're adhering to the SEC guidelines of managing money. And I don't blame the SEC. I've always kind of chuckled at MPT. Oh boy. You coming out, Pops? Again, because the idea of a free lunch always kind of ticks me off. Like, oh, I'm diversified. Yeah, what happened in 2008, guy? Everything went down except for government bonds. Now everything's going down to include government bonds except for commodities. So where's your diversification? None of that rescued you. None of that rescued you. What happened in 2001 and 2? Oh, pretty much everything went up except for large cap growth, small cap growth, growth stocks. So again, if you're diversified, you did not weather the storm that well. That's a fact, especially if you had no bonds. If you had bonds, you did pretty well. You did fine. But you just don't know. No one could have said 7 months ago the commodities are going to be the one thing that gives us a reprieve from a drop of, basically getting close to a bear market. Anyway, I hope this helps. I just tell my man, I said, look, just hang in there. I mean, unless you want to manage it yourself, because like I say, no one can lose money like I can. But he doesn't want to do that. I said, then don't. Let these guys do it. They're not charging arm and a leg. They know what they're doing. That doesn't mean they're going to make you money, but they're not churning your account. They're trying to make you money with less risk than they think you would take on your own. Oh, and by the way, what did they do? First thing they did when he went into the intelligent portfolio, they sold Cathie Woods. So my man forgot. I tell you, man, it's how quickly we forget when the market's going down. My man forgot that they sold him Cathie Wood, and now he's like, oh, yeah, I guess that's probably a pretty good thing, because Cathie Wood is down, what, 60, 70% or something like that. All right, looks like my dogs need some water. Love to hear your thoughts. We'll see ya.